Welcome. Today we're diving into the world of credit scores and their crucial role in consumer banking. Whether you're applying for a loan, opening a new credit card, or even renting an apartment, your credit score can have a significant impact. But what exactly is a credit score and why do banks care so much about it? In this video, we'll break down the basics, explore how credit scores are calculated, and explain why they matter for your financial future. Let's start by understanding what a credit score really is and how it fits into the broader banking landscape. Credit score is a three-digit number that represents your creditworthiness. It's based on your credit history, including how much debt you have, your payment history, and the length of your credit accounts. Lenders use this score to assess the risk of lending you money. The higher your score, the more likely you are to be approved for loans and credit cards, often with better terms. Understanding your credit score is the first step to managing your financial health and making informed decisions in consumer banking. Credit scores are calculated using several factors. The most important is your payment history, whether you pay your bills on time. Other factors include the amount of debt you owe, the length of your credit history, the types of credit you use, and recent credit inquiries. Each of these elements contributes to your overall score, which typically ranges from 300 to 850. Knowing what affects your score can help you make smarter financial choices and improve your standing with banks. Banks rely on credit scores to make lending decisions. When you apply for a loan or credit card, your score helps the bank predict how likely you are to repay the debt. A higher score means you're seen as a lower risk, which can lead to better interest rates and loan terms. On the other hand, a lower score might result in higher rates or even denial of credit. This system helps banks manage risk and ensures they lend responsibly. If you apply for a loan, your credit score is one of the first things a bank checks. It helps them decide not only whether to approve your application but also what interest rate to offer. A strong credit score can open doors to larger loan amounts and more favorable terms, while a low score might limit your options. This makes maintaining a good credit score essential for anyone planning to borrow money in the future. Credit card companies also use your credit score to determine your eligibility for different cards. A high score can qualify you for premium cards with rewards, lower interest rates, and higher credit limits. Conversely, a lower score may restrict you to basic cards with fewer benefits and higher fees. Your credit score essentially shapes the types of credit products available to you, making it a key factor in your financial toolkit. One of the most direct ways your credit score impacts your finances is through interest rates. Banks offer lower interest rates to borrowers with higher credit scores because they're considered less risky. This can save you a significant amount of money over the life of a loan. On the flip side, a lower credit score often means higher interest rates, which can make borrowing more expensive and challenging to manage. It's not just banks that care about your credit score. Landlords often check credit scores when you apply to rent an apartment. A good score can make the rental process smoother and may even help you negotiate better lease terms. On the other hand, a low score could make it harder to secure housing or require a larger security deposit. This shows how credit scores affect many aspects of your financial life beyond just banking. Some employers, especially in financial industries, may review your credit report as part of the hearing process. While they don't see your exact score, your credit history can influence their decision. A strong credit history suggests responsibility and reliability, qualities that are valued in many jobs. This is another reason why maintaining a healthy credit profile is important, even if you're not planning to borrow money right now. Insurance companies sometimes use credit scores to help set premiums for auto or home insurance. The idea is that people with higher credit scores are less likely to file claims. As a result, a good credit score can lead to lower insurance costs, while a poor score might mean higher premiums. This is just one more way your credit score can influence your overall financial well-being. It's important to understand the difference between a credit report and a credit score. Your credit report is a detailed record of your credit history, including accounts, payments, and inquiries. Your credit score is a numerical summary of that report. Both are important, but your score is what lenders usually focus on when making quick decisions about your creditworthiness. In the United States, there are three major credit bureaus: Equifax, Experian, and TransUnion. These agencies collect and maintain your credit information, which is then used to calculate your credit score. Each bureau may have slightly different information, so your score can vary depending on which report a lender checks. It's a good idea to review your reports from all three bureaus regularly. Two most common credit scoring models are FICO and VantageScore. Both use similar criteria but may weigh factors differently. Most lenders use FICO scores, but VantageScore is becoming more popular. Understanding which model your lender uses can help you better interpret your score and take steps to improve it. Credit scores typically range from 300 to 850. Generally, a score above 700 is considered good, while scores above 800 are excellent. Scores below 650 may make it harder to qualify for loans or get favorable terms. Knowing where you stand can help you set goals for improving your credit and accessing better financial opportunities. Building a strong credit history takes time and discipline. Start by paying your bills on time, keeping your credit card balances low, and avoiding unnecessary debt. Over time, these habits will help you establish a positive credit profile, which can lead to a higher score and better financial opportunities. Your payment history is the single most important factor in your credit score. Lenders want to see that you consistently pay your bills on time. Even one missed payment can have a negative impact, so it's crucial to stay on top of due dates and make at least the minimum payment each month. Credit utilization refers to the percentage of your available credit that you're using. Keeping your balances low compared to your credit limits can boost your score. Experts recommend using less than 30% of your available credit. High utilization can signal risk to lenders, even if you pay your bills on time. The length of your credit history also plays a role in your score. Lenders like to see a long track record of responsible credit use. This means keeping old accounts open, even if you don't use them often, can benefit your score. The longer your history, the more data lenders have to assess your reliability. Lenders also look at the variety of credit accounts you have, such as credit cards, mortgages, and auto loans. Having a mix of credit types can improve your score as it shows you can manage different kinds of debt responsibly. However, don't open accounts you don't need just to diversify. Each time you apply for new credit, a hard inquiry is added to your credit report. Too many inquiries in a short period can lower your score as it may signal financial distress. It's best to apply for new credit only when necessary and to space out your applications. It's important to check your credit score regularly. Many banks and credit card companies now offer free access to your score as a customer benefit. Monitoring your score helps you spot errors, track your progress, and take action if you notice any sudden changes. Mistakes on your credit report can lower your score. If you find an error, contact the credit bureau to dispute it. Providing documentation can help speed up the process. Correcting errors ensures your score accurately reflects your financial behavior and can improve your chances of getting approved for credit. Identity theft can have a devastating impact on your credit score. If someone opens accounts in your name or racks up debt, it can damage your credit profile. Protecting your personal information and monitoring your credit report regularly are key steps to prevent identity theft and safeguard your financial reputation. If your credit score is lower than you'd like, don't worry, there are steps you can take to improve it. Focus on paying bills on time, reducing your debt, and avoiding new credit inquiries. Over time, these actions will help rebuild your score and open up better financial opportunities. Bankruptcy is a serious financial event that can significantly lower your credit score. It remains on your credit report for up to 10 years, making it harder to qualify for loans or credit cards. However, with time and responsible financial behavior, it's possible to recover and rebuild your credit. Settling a debt for less than you owe can negatively impact your credit score. While it may help you resolve outstanding balances, it signals to lenders that you didn't pay the full amount. It's important to weigh the pros and cons before pursuing debt settlement as a solution. Student loans are a common type of debt that can affect your credit score. Making payments on time helps build a positive credit history, while missed payments can hurt your score. Managing student loans responsibly is an important part of maintaining good credit, especially for young adults starting out. Auto loans are another common form of credit. Like other loans, your payment history on an auto loan is reported to the credit bureaus. Consistently making payments on time can boost your score, while missed payments can have the opposite effect. This is why it's important to budget carefully before taking on a car loan. Mortgage is often the largest loan most people will ever have. Your credit score plays a major role in qualifying for a mortgage and determining your interest rate. Making mortgage payments on time is crucial for maintaining and improving your score, while missed payments can have serious consequences. Credit cards are a powerful tool for building credit, but they can also hurt your score if not managed wisely. Keeping your balances low and paying off your statement in full each month can help you maintain a healthy credit utilization ratio and boost your score over time. There are two main types of credit: secured and unsecured. Secured credit, like a mortgage or auto loan, is backed by collateral. Unsecured credit, such as most credit cards, isn't tied to any asset. Both types can impact your credit score, but unsecured credit often carries higher interest rates and more risk for lenders. Becoming an authorized user on someone else's credit card can help you build credit, especially if you're just starting out. The primary account holder's payment history is reported on your credit file, which can boost your score if they manage the account responsibly. However, missed payments can also hurt your credit. Joint accounts, such as shared credit cards or loans, affect both account holders' credit scores. Both parties are responsible for payments, and any missed payments will appear on both credit reports. It's important to communicate and manage joint accounts carefully to avoid damaging each other's credit. Closing old credit accounts can sometimes lower your score, especially if it shortens your credit history or increases your credit utilization. Before closing an account, consider how it might affect your overall credit profile. In many cases, it's better to keep old accounts open, even if you don't use them often. There are several tools available to help you build or rebuild your credit. Secured credit cards, credit builder loans, and becoming an authorized user are all effective strategies. These tools can help you establish a positive payment history and improve your credit score over time. If you're struggling with debt or credit issues, credit counseling services can provide valuable guidance. These organizations can help you create a budget, negotiate with creditors, and develop a plan to improve your credit. Seeking help early can prevent problems from getting worse and set you on the path to financial recovery. Your credit score is a key factor in achieving many financial goals, from buying a home to starting a business. A strong score can help you qualify for better loans, lower interest rates, and more favorable terms. Setting credit-related goals and tracking your progress can help you stay motivated and make smarter financial decisions. Good credit score can be a lifesaver in a financial emergency. It can help you qualify for emergency loans or credit lines when you need them most. Maintaining a strong score ensures you have access to financial resources in times of need, providing peace of mind and security. Even as you approach retirement, your credit score remains important. It can affect your ability to refinance a mortgage, take out a home equity loan, or qualify for new credit. Keeping your score healthy ensures you have financial flexibility and options later in life. Credit scores can even play a role in personal relationships. When couples apply for joint loans or mortgages, both credit scores are considered. Open communication about credit and finances is essential for building trust and achieving shared financial goals. There are many myths about credit scores, such as the idea that checking your own score will lower it or that you need to carry a balance to build credit. In reality, checking your own score is a soft inquiry and doesn't affect your score. Paying your balance in full is always better than carrying debt. Credit scoring systems vary around the world. If you move to another country, your credit history may not transfer. Some countries have their own credit bureaus and scoring models. If you're planning to live abroad, research the local credit system and start building credit as soon as possible. With the rise of digital banking, it's easier than ever to monitor your credit score and manage your finances online. Many apps and online banks offer free credit score tracking, budgeting tools, and alerts for changes to your credit report. Embracing these digital tools can help you stay on top of your credit and make informed decisions. Credit scoring models are evolving, with new technologies and data sources being used to assess creditworthiness. Alternative data, such as utility payments and rental history, may soon play a bigger role. Staying informed about these changes can help you adapt and maintain a strong credit profile in the future. Sum up, your credit score is a powerful tool that affects nearly every aspect of your financial life. From securing loans and credit cards to renting an apartment or even landing a job, maintaining a healthy credit score opens doors and provides financial security. By understanding how credit scores work and taking steps to improve yours, you can achieve your financial goals and enjoy greater peace of mind.